The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The quarter ends is almost as strong as it began, with equity bulls still calling the shots. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Katie Greifeld. We're kicking you off to closing bell here in the U.S. And as Romaine mentioned, a big finish to the end of the month and to the end of the quarter. The S&P 500 continuing that climb higher by about 0.8% at the moment, led once again, similar to yesterday, by big tech, by the chip makers. The NASDAQ 100 higher by 1.7% at this moment. It's going to be interesting to see if we get any fireworks heading into the close today. I did want to draw your attention to the VIX continuing to slide as the lines continue to go up. The VIX now trading with a 16 handle, even though you are seeing a bit of a sell-off develop when it comes to the bond market. We're still relatively low relative to recent history when it comes to levels, but 10-year Treasury yields down by about 4 basis points, Romaine.
They're still sitting on some modest gains on the month and on the quarter for the fixed income market. As for stocks, that quarter end melt up, led by big tech to round out what is going to be the best quarter for stocks since that pandemic rebound in 2020. This all despite some of the late quarter hand-wringing about the durability of the AI trade. Hand-wringing that led to some brief pullbacks, but not far back enough. 9 of the 10 best performing stocks in the S&P this quarter, as expected, AI beneficiaries like Micron, like Intel, like Dell, and like Flex. And a big part of that story, of course, was the persistence of retail traders who look to buy almost every dip out there. Data out by Citadel today shows May and June smashing monthly retail trader activity records, with 9 of the most active trading days ever recorded by the firm happening within that period. And that buying wasn't just speculative. Case in point, earnings growth for AI companies. It was a major reason the S&P overall could actually exceed 20% EPS growth in 2026. That's a number rarely achieved outside of recession recovery periods. And if the cyclical and non-AI sectors actually begin contributing more, we could see a replay of that 2021 post-pandemic profit boom, a boom that would be supported by an improving macro backdrop as well. After all, Brent crude just posted its biggest monthly drop since March 2020. The dollar, that's poised for its first back-to-back monthly gains of the year. And the number of U.S. job openings out there just rose to the highest since 2024.
Certainly making waves in the bond market today. And with that in mind, let's take a little look at where the appetite is when it comes to fixed income as measured by ETF flows. This data comes courtesy to us of Bloomberg Intelligence. And I think it's really interesting. This is 2026 so far. You can see that the biggest demand is for ultra short duration fixed income funds. About $64 billion has been poured into that maturity bucket so far this year. Intermediate, interestingly, is in second place. So more of the belly of the curve, as we've been talking about. Short-term debt, though, also seeing inflows of about $35 billion. Really flows across the board until you get to long-dated debt. This is something that we've been talking about for months, for years. It seems like there's just this distaste to go out the yield curve, and that's continuing in 2026. It's slight outflows relative to all the money that's coming into the fixed income ETF market, but still, we're talking about $500 million that has been yanked from long-dated fixed income funds so far this year, Romaine.
Absolutely. Let's bring in Steve Laipply into the conversation, global head of iShares fixed income ETFs over at BlackRock. I look at the gains in the equity markets. I look at the relatively modest gains this past month and this past quarter in the fixed income space. But I'm also looking at a 30-year Treasury yield at 4.9%. Your 20-year not quite far behind it, and you're still getting 4% coupon on a 10-year bond, Steve. Why don't you think people are extending duration?
Yeah, that's really interesting, Romaine. If you look at returns, actually the long end is not doing bad. The 20-plus year part of the curve, we look at something like TLT, is actually outperforming the 1 to 3 year part of the curve. And I think that might surprise people. So, yeah, the long end is something that generally investors have shied away from. We did have a couple of years there where there was a lot of money flowing into that. But most of the money in treasuries is, in fact, going to the short end, as you all pointed out. But I think the bigger story is flows in general. In the U.S., bond ETF flows are up 60% relative to last year. That was a record last year. Year before was a record. So it's really something that we're up 60% on top of that.
Are people out there, are they chasing more price or are they chasing more the yield?
I think it's all about yield. And it's that simple. We get asked all the time, whether investors are concerned about the volatility they see. The 10-year has gone from sort of mid fours up to 5, down into the high 3s, and then sort of back to the mid 4s over the last couple of years. But investors are looking past that, and they're simply allocating based on the income opportunity. I mean, if you look at the universe, the vast majority of fixed income is above 4%. You have to go back to the early 2000s for that. And investors are responding. They want income in their portfolios, and they're able to get it for the first time in a long time.
And it seems like they're happy to get that income when it comes to, the shorter end of the yield curve. Steve, I want to go back to that point you made on TLT outperformance relative to some of those shorter maturities, because certainly when you look at the flows, that would seem unintuitive. You don't actually see money following performance right now as it tends to. And you reference that period of time where TLT was taking in a ton of money, even though it wasn't doing all that hot. And I wonder, what that says about the moment that we're in. The fact that there is still this distaste seemingly for the long end. Does that speak to, longer term inflation concerns, or what are you hearing?
I think it's a couple of things. There's still a lot of concern about the fiscal imbalances long term. And so investors, are looking to get compensated for that in terms of, if you go further out the curve, you're going to want some term premium. You're going to want to see, a stabilizing fiscal situation. I think there's a lot of wait and see on that. We have obviously a new Fed chair. So there's going to be wait and see on how the Wuerffel Fed evolves and how it differs from the prior Fed. And so I think that's causing people to be a little bit gun shy. In terms of inflation, that's a really interesting story because, sure, the headline numbers have been where they are at elevated levels, but the break-even, the market-implied inflation, especially in the short end, has absolutely plummeted the last several weeks. So you look at two-year break-evens, they went from a high of around 340 all the way down to about 2%. So long-term, the market's sort of looking past the current pressure that was brought on by the rise in energy prices and the conflict, and really looking at inflation, being around that 2% level. So if investors are still worried about inflation, short-dated tips actually look pretty attractive right now.
I also want to get your thoughts on the corporate credit side of things, because we've seen a ton of issuance when it comes to the primary markets, particularly from big tech, as you think about this AI build out and how it's being funded. I wonder how you're thinking about that through a product creation lens, because it seems like there's a lot of focus, of course, on investment grade debt, especially as you see the Magnificent Seven sort of wake up and tap the primary markets in ways that they haven't in years. How does that sort of affect potentially the lineup over at iShares?
Well, the indices will eventually pick up those issues depending on their maturity range, et cetera. What we've seen, interestingly, I mean, June was a record month for IG issuance. There is talk that is causing some crowding out and competition across the sectors. But really, the issuance has been fairly well received. I mean, investment grade credit spreads are still in the mid 70s. High yield credit spreads are a couple hundred above that, both of which are sort of in the tighter range over time. And so the market has been absorbing this. I think it's just, one more, kind of sector and build out of the offering and more opportunities for investors to have. But what I do think is interesting, something that's kind of overlooked that we do focus on in our active strategies would be European credit. So if you look at European investment grade and European high yield, it's actually doing pretty well, even relative to U.S. investment grade and high yield. So that's a story that I think hasn't really been looked at that closely.
All right, Steve, always appreciate it. Steve Laipply there, global head of iShares fixed income ETFs over at BlackRock, kicking us off to the close here on this final trading day of the quarter. When we come back, a deeper dive into, well, one of the biggest conflicts that rocked the quarter and the unresolved issues still surrounding it. We're going to catch up with former U.S. Treasury Secretary Jack Lew in just a second for a sweeping conversation about what's next for financial markets and global affairs.
And from global headlines to global brands, Nike set to report results after the bell. We'll have full coverage on that report, and investors feel the numbers are the right fit for portfolios, which I believe is a shoe pun.
And we're going to go from an iconic sports brand to Yao Ming. He's a Hall of Famer, NBA Hall of Famer. We had a chance to catch up with him. He's actually got a lot of new business ventures. He's got some thoughts as well on the state of basketball. That conversation and more coming up in a bit, right here on The Close, right here on Bloomberg.
The growth of the U.S. Treasury market is reshaping finance as we know it through new liquidity dynamics and structural shifts. The SEC so far sticking with its December deadline to bring most Treasury cash transactions into central clearing. That's an initiative that could further cement this new era for Treasuries. Joining us live in studio to discuss is Nate Wuerffel. He is head of market structure and head of product for the global collateral platform over at BNY. Also, former head of domestic markets at the New York Fed. Nate, great to have you with us.
Thanks for having me.
So let's talk through some of these deadlines. As I mentioned, for cash treasuries, that's December 31st. Repo is June 30th, 2027. So actually exactly a year away, which is wild. As we get closer and closer to this deadline for central clearing here, what in your view are still the biggest hurdles yet to clear, for lack of a better pun?
Yeah, well, I'd say just to start with, I mean, the Treasury market really is the world's most important bond market, and it was founded on these principles of safety and liquidity all the way back to Alexander Hamilton, the forefather of the Treasury market. And those principles have really propelled the Treasury market to be what it is today, not just financing the government, but also the place where monetary policy is implemented. And then it drives really capital markets around the world. It's the risk-free benchmark. Consumer loans, corporate loans, mortgages, everything really pins on the Treasury market. And the Treasury market's gone through these episodes of stress, and that's why there's been so much focus on resilience. And the central clearing rule is really one of the main ways to make the Treasury market more resilient and safe. You've got these deadlines coming up. I think the market is in a good position to continue progress. We've seen a lot of increase in central clearing of Treasury transactions. So we're seeing a lot of progress already to date.
So still a lot of progress. So it sounds like in your view, there isn't like one issue that's emerging as a sticking point here as we get closer and closer.
Yeah, there are a couple of issues that are outstanding that I think the SEC is really focused heavily on. Some of them have to do with the global nature of the Treasury market. So there are firms that transact the Treasury market around the world. And the way the central clearing rule is constructed requires firms to think about transactions not just that are done in the US, but really in locations around the world. So being able to clear those types of transactions is important, and the SEC is still working through some of those dynamics. I mean, central clearing is one of the most important changes to the structure of the Treasury market because it interposes a CCP in between the two counterparties of a trade. So you don't face your counterparty anymore, you actually now face the CCP, and that reduces counterparty credit risk, but it also means that the structure of the Treasury market's really being reassembled.
Wasn't also the point to trying to broaden access as well? Does this actually accomplish that, or do you see it accomplishing that?
I do think it's supportive of that. I mean, generally, centrally cleared markets, what you see is that they are safer, and therefore they tend to attract capital. And so I think you will see more participation in the Treasury market. And in times of stress in the past, when counterparties have backed away from each other because of concern about settlement risk, if you don't face that kind of risk anymore because a CCP is guaranteeing your transaction, then I think that can bring more participation into the market, especially in times of stress.
This is still a huge undertaking, and I am curious, given all the legal issues and documentation that still has to be sorted out, you're confident that we'll hit that 6-month deadline, or do you anticipate maybe we might see an extension?
I mean, the SEC already extended the deadlines by 1 year. So the first one, the important deadline this year is at the end of the year for purchase and sale transactions. Even bigger deadline, I would argue, is at the end of June for the repo market, and that's more complex because it involves more infrastructure change. I think the SEC has said, we've given you an extra year, and now it's really up to the industry to make sure that it's making progress on this. There are these couple of issues that the SEC needs to address, but I'll take a glasses half full view of the world here, that I think the industry is making some good progress towards these compliance days.
Well, Nate, I also want to get your thoughts on supply, since we know that there's pretty heavy Treasury supply that we're coasting into right now, particularly when it comes to bill supply. You think about July and August, what we're expecting to see there. What's your thoughts on how this will be received by the market? Could this pressure short-term rates higher, or do you think that this will be well digested?
I mean, I think supply, if you just look at, from a wide lens, it's a $30 trillion market today. If you look at a lot of forecasts, including by the Congressional Budget Office, you've got supply growing to be, the market growing to be over $50 trillion in the next 10 years. So supply writ large is definitely on the minds of market participants. Can the market absorb that supply, and can intermediaries help the market continue to function in times of stress with that supply? I think in the short term, what we've seen is some changes in the way that the Federal Reserve is operating monetary policy. So they're operating this ample reserves framework, and that's given quite a bit of liquidity in the short-term marketplace. So it's been able to absorb shocks pretty well.
So, but also with regard to just making things a little bit safer. So the idea is that there's going to be more collateral out there, right? But who's bearing that cost? Does that fall on the dealers? Does that fall on who? The intermediaries? Where?
Yeah, it's a great question. I think that the intermediation of the market is one of the key areas that both the public and the private sector have talked about as being an area that needs to be resilient. You need to have intermediaries that have this capacity. If you look at these big structural trends in the market, one is growing supply, changing Fed policy. The second is, can intermediaries, can they function well? You've seen some changes in regulations, loosening of the restrictions around the leverage ratio. Also now they're looking at some of the liquidity ratios. That could over time help intermediaries facilitate transactions in the Treasury market.
All right. Great to have you here, Nate. Nate Wuerffel there, head of market structure and head of product for the global collateral platform over at BNY, also former head of domestic markets at the New York Fed. As we count you down to the close, count you down to the end of the quarter, and we take a look at one of the laggards out there over the last few months, and that's Microsoft. The shares heading for their worst month in 26 years. We're going to assess some of the pain points and actually talk to an analyst who actually makes a pretty good bull case for maybe why you should be buying into this dip. That conversation coming up after the break, right here on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. And we're going to start off with a call to sell big bank stocks and buy alternative asset managers. At least that's a note from Oppenheimer's Christopher Kotowski, who downgrades Goldman Sachs and Morgan Stanley to underperform, citing heavy leverage that could prompt another fear cycle, though he doesn't actually specify the catalyst. Kotowski says stick to boring banks like PNC or alt managers like Ares and KKR. Goldman Sachs shares down about 0.4% on the day. Next up, Rocket Companies benchmark initiating coverage of the mortgage originator with a buy and a $21 target. The firm saying Rocket's partnerships position the company to become one of the two dominant real estate portals over the next decade. Those shares up about 3% on the day. And finally, let's take a look at SanDisk. Bernstein out with a new $3,000 price target, up from $1,700. An outperform rating saying the chip maker's new customer agreements provide a solid runway for the stock. The shares up 10% here on the day to close out the month of June. Another stock that we are keeping an eye on is Microsoft, headed for its worst monthly performance in 26 years. Its fourth straight quarter underperforming the S&P 500. But our next guest, he still got his outperform rating on the stock with the 640 price target and does see the potential for some upside. Rishi Jaluria, Managing Director of Software Equity Research at RBC Capital, joins us right now. And Rishi, we should just kind of put this in context. I mean, the whole impetus for this big slide that we've seen in Microsoft over the past few months is seemed to be tied to this idea that AI will somehow eat its software lunch. I am curious about your thoughts as to, now that we've gotten a little bit more clarity as to the balance between AI and the traditional software space, where does Microsoft sort of fit into that equation?
Yeah, absolutely. Thanks so much for having me. Always a pleasure to be here. Look, I think that's exactly right. Microsoft is in a tricky situation because on one hand, they're getting hit on that narrative that AI is going to replace application software, especially those that are reliant on a seat-based model. And at the other side, there's, I think, growing impatience over high CapEx bills. And Microsoft has talked about no signs of their CapEx slowing down. So they're kind of getting hit on both sides of the equation. But look, as we've done work on this AI and software thesis, increasingly are convinced that it's not a one or the other. It's very much intertwined. That even buyers think about AI as being a form of software, right? And even if it's going to take on a new shape and form, kind of that mixing of the two of them. And we recently published our mid-year enterprise CIO survey, and that showed very encouraging stats, not just for enterprise AI adoption, but for continued software spending, and actually very encouraging for Microsoft. And really importantly, I think the companies that can actually find ways to innovate around AI, add all the enterprise guardrails, and have that integrated in the existing system of record, system of engagement, system of action, those are the companies that are going to benefit. And I think Microsoft is very high on that list.
Well, Rishi, as you say, it's sort of a double whammy for Microsoft. You have the CapEx concerns, which the company isn't backing away from their commitment to spending there. But then there's also sort of the AI disruption fears, which isn't unique to Microsoft, of course. But what gives you the confidence that some of Microsoft's biggest products, you think about Word, Excel, that entire Office suite, won't actually be rendered obsolete by AI?
Yeah, absolutely. Look, I would say there's two things. Number one is the actual cost of replacing the entire Office suite, so Word, Excel, PowerPoint, but also Outlook, Teams, OneDrive, SharePoint, the actual cost of that will be minimum 10 times more expensive if you did it yourself, even if you're the most capable organization in the world. So that I think we can rest to bear those sort of concerns. But I think the bigger thing that gives me confidence is Microsoft seems to finally be getting their act together on Office Copilot. Obviously, they came out with that product a couple years ago with a lot of fanfare, and I think most of us would agree it's been a disappointment so far. But ever since Satya stepped back into kind of the product and engineering side back in November to kind of fix the product, we've seen meaningfully improving customer feedback, a meaningfully better Office Copilot product, and it's starting to show up in the leading indicators. You saw that they added 5 million paid Office Copilot subscribers last quarter, and they expect to do more than that this quarter, the quarter ending today. They've talked about Office Copilot engagement being on par with Outlook. Like, yes, it's a little later than we would have expected, but I think Microsoft finally seems to be getting their act together on Office Copilot. And if they can deliver that to have enough value and enough engagement, that gives me a lot of confidence that in spite of seat-based headwinds, deal elongation, that Microsoft will emerge from this in a stronger position.
Azure, Rishi, is that the hedge here?
I think that's right. I mean, Azure is where everyone's focused on right now. And, to a certain extent, I think the market is not happy, and this would explain some of Microsoft's underperformance. The market is not happy with some of the decisions that Microsoft has made on the Azure side, namely allocating first-party capacity to applications like Office Copilot, GitHub Copilot, where there's no actual revenue association with Azure, versus to third-party customers, including OpenAI and Anthropic.
Right.
The thing is, even if that third party would result in a higher Azure number in a given quarter, from a longer-term perspective, that's probably the right thing for the business to do.
All right, Rishi, really appreciate you stopping by. That is Rishi Jaluria talking about Microsoft. This is Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Katie Greifeld, keeping an eye on quarter end in these markets while also keeping an eye on the geopolitical situation, because we heard from Qatar saying that Jared Kushner and Steve Witkoff have arrived in Doha as part of those peace negotiations between the U.S. and Iran, but the two sides are not set to meet directly necessarily.
These are indirect talks,
yes.
as I think Bloomberg has been framing it, which I think gives you a little bit of sense of just how much, let's just say, road to walk there is with regards to getting this resolved. But, there's been a lot of talk obviously about the potential of getting the flows out of the Strait of Hormuz, what the situation is going to look like in terms of an actual final deal and how much control Iran would actually have over the strait with regards to being able to potentially charge tolls, and then obviously the lifting of sanctions, and maybe even obviously the payback of some of their money.
Yeah, so a lot to work through indirectly here. Of course, we're going to be monitoring this very closely. And let's keep this conversation going now with Jack Lew. He is former U.S. Treasury Secretary and former ambassador to Israel, joining us on set. Jack Lew, it's great to see you.
Good to be with you.
So let's talk a little bit about this current round of talks, indirect talks here. The president himself seems to be sort of mum on the idea of whether or not there's going to be a substantial breakthrough that's produced by this week's round of negotiations. But what do you think would constitute success at this point, given the weeks, the months of back and forth here?
So I would focus less on whether the meeting is face-to-face or through intermediaries. Successful negotiations can come either way. There's still a considerable amount of ground to cover. The agreement that was reached a few weeks ago is a memorandum of understanding. It doesn't lay out in any detail what a nuclear agreement would look like. There are things in that we can talk about that give you some idea of what the shape might be, but it doesn't tell you how the really tough issues will be resolved. Do you get highly enriched material out of Iran? Do you have an inspection regime where you know what's going on? Will the sanctions relief be provided too soon to have maximum leverage? That's a bit of a fear.
And I mean, what you mentioned there, especially when it comes to the enriched uranium, when it comes to the nuclear portion of it as well. Before you even get there, I mean, you have the Strait of Hormuz, and there's a lot of question marks there as well. Iran reiterating its determination to control traffic through the Strait of Hormuz. I mean, I have to imagine heading into these talks that only adds pressure, the disagreements over whether or not the strait is actually going to be opened, who's controlling it, whether there's going to be tolls.
So just to level set, the Strait of Hormuz wasn't an issue until this war. So back in 2015, when we negotiated a nuclear agreement with Iran, the Strait of Hormuz wasn't closed before or after. So coming out of this memorandum of understanding was really just a commitment of some kind to reopen the Strait of Hormuz that was closed because of this war. We don't know under what terms the Strait of Hormuz will be reopened. There's language in the memorandum of understanding that each side is reading differently, where Iran believes that they've been, in some sense, given more control over the Strait of Hormuz than they had before. That's unfortunate. I hope it doesn't end up there. It does seem, whether they charge a fee or not, they certainly have increased their kind of control over the Strait of Hormuz.
I am curious just about the effectiveness of sanctions. I mean, you get credit for being, rightly or wrongly, for being kind of the architect of kind of the modern sanctions playbook. And I am curious that when you saw the way that those sanctions were applied to Iran, and you can throw Russia in there, for example, as well, is that still a viable way of the U.S. trying to extract what they want out of these nations?
I think economic sanctions are extraordinarily important tools for the United States. When you think about what stands between a disagreement or a conflict and war, it's often these economic measures that give you some ability to avoid kinetic action. So if your goal is to keep actual armed conflict down, you actually want these economic tools to be effective. Economic tools can be very effective. In 2015, the reason there was a nuclear agreement with Iran is the economic pressure got great enough that they were willing to negotiate a nuclear deal. But you have to understand what your leverage is and what the other side's leverage is, what your level of endurance for pain and the other side's level for endurance of pain, and whether there are countermeasures. I think in the current situation, what we've seen is there was an exaggerated sense of what could be accomplished militarily. Ultimately, there has to be a negotiated outcome. The imposition of pain on Iran in some ways caused them to have more endurance for pain because they're like in it till the end. They also saw the U.S. response to higher gasoline prices weakened our ability to withstand a closure of the Strait of Hormuz. So these tools are hugely important, but they have to be used with care.
Are they starting to run its course, though? And I want to put that into the context of the dollar being the reserve currency and the idea that you have so many nations trying to find ways around it unsuccessfully. But on the margins, you've seen China, you've seen Russia, India, and a few other countries on the margins find ways to get around it. Is the influence of the dollar, particularly through the lens of sanctions and American power, is that waning?
So look, I have for years thought that the question you're asking should be very much on the minds of policymakers, because we ought to be cognizant of the fact that over the horizon that could happen. I don't believe it has yet occurred. What we've seen during this back and forth with Iran is that at moments of maximum stress, there was an increase in transactions and currencies other than the dollar, and there was a use of the plumbing that's been built to get around the dollar. But as soon as the tension went down, even for a day or a week, it came back to the dollar. There's simply nothing other than the dollar that's available in the depth and liquidity to serve global markets. That's not a reason to believe it will always be that way. I think that policymakers have to constantly have in mind that you can actually make it so that the tool doesn't work at some point. I think that you should reserve the use of sanctions for truly high priorities, for things that sanctions can deliver a change of a sovereign policy. Sanctions are not meant to be punishment to the people of a country. They're meant to be a coercive tool to get another government to change its policy. That means you have to sit at a negotiating table. And rhetoric about destroying each other is not necessarily conducive to that. Look, I hope that the MOU launches a follow-on negotiation that can put back in place a nuclear agreement so there can be a negotiated level of comfort that Iran is not on a path towards developing a nuclear weapon. Long way to go and a lot of wood to chop because the MOU doesn't give you the details.
I would also love to get your perspective on Israel and the U.S. relationship, given that you are the former ambassador to Israel. You think about the U.S. and Iran, they've largely refrained from attacking each other since that ceasefire was agreed to. Some tit for tat back and forth there. But when you think about Israel and Hezbollah, I wonder how much of a wrench that could potentially throw into these negotiations. And I'm also curious, in your view, whether you think the U.S.-Israel relationship is fundamentally altered by this war.
Look, any conversation about Israel and Hezbollah has to be rooted in the reality that Hezbollah sits on Israel's northern border determined to destroy Israel. So there is a real threat there. How you respond to that threat, what's proportional, what can be successful. My own view is that strengthening the government of Lebanon is key, and the strategy ought to be towards strengthening the government of Lebanon and the Lebanese armed forces. Iran has a role to play in this. Iran could curtail the activities of Hezbollah. They have more control than they like to admit. I hope in this negotiation, if you look at the beginning of the MOU, it kind of throws this issue in there in a confusing way. It makes it seem as if there's kind of some recognition of Iran's interests in Lebanon, but it doesn't hold Iran accountable for any of that. I think Israel's been in a very difficult place since the attacks of October 7th. I don't think it's an exaggeration to say that the country remains a country in trauma. It feels that there remains an existential threat. I think there's many things that the policies that have been taken by the government that when I was ambassador, we tried to contain some of the military action to make it aimed at the things that were most necessary, not more widespread than necessary. I think there's been a lot of change in the U.S.-Israel relationship, even in the year and a half that I've been back. I think the government there would be kind of well advised to think about how its actions give people here the ability to see that they have a legitimate right to defend their country. And the rhetoric coming out of the current government in Israel makes that very hard, even for people who want to defend what Israel is doing. So I don't want to opine on whether the relationship is permanently changed. I do think there are things that the government over there, they have an election in October.
Right.
They're going to need to do some hard thinking about the strategic relationship with the United States and what it takes to have a reset.
All right, Jack, we have to leave it there. Always appreciate it. Thank you.
Good to be with you.
Former U.S. Treasury Secretary Jack Lew there, and of course, now a professor over at Columbia University. When we come back, we're going to take a look at Blackstone cashing out on a big data center bet. That's coming up next, right here on The Close on Bloomberg. Time now for our stock of the hour. Taking a look at shares of Blackstone and Digital Realty moving in opposite directions. Blackstone selling a stake in a trio of data centers out in Virginia for $3.5 billion to Digital Realty. Nora Melinda joins us right now to talk about this. Blackstone selling data centers? Why are you selling data centers? I thought they were the future.
Right? I mean, This is where everybody's headed.
Yeah.
So this is a story that's really interesting because of the fact that Blackstone's not ditching data centers. If anything, they're reinforcing their position when it relates to data centers. So I think about this deal in a way as Blackstone actually essentially recycling their cash flow, their capital, and they're redeploying it into other hyperscaled projects. And when we think about Digital Realty in this deal in particular, they still have hyperscalers that are currently leasing these properties, these data centers. So while you are seeing the stock lower, at least as it relates to Digital Realty, I'm still seeing analysts on Wall Street that are saying that this is a good deal for both companies here. And it really does show that it's reinforcing the bet, both of them just using it in a different strategic way.
And so, in 40 seconds or so, I mean, why now? I hear what you're saying about, some of the strategic features of this deal that the sell side is seeing, but talk to us a little bit about the timing.
Right. So this is, of course, when we think about Northern Virginia, also known as Nova. It's the largest data center market in the United States. And as we think about these companies really wanting to scale, we think about the fact that investors are really looking toward digital realty, which has performed really well this year. They're looking for them to really be able to double down on their artificial intelligence infrastructure bets. And you're seeing that happening right now as we look at this deal and as we investors really think more broadly about the future.
All right, Nora, really appreciate the context. That is Bloomberg's Nora Melinda. She is our TV markets correspondent. And speaking of markets, we're just about 15 minutes away from the close of the day, the month, and the quarter. We're going to take you to the closing bell with Tiffany McGhee. She is CEO and CIO of Pivotal Advisors. This is The Close on Bloomberg.
In terms of inflation, that's a really interesting story because, sure, the headline numbers have been where they are at elevated levels, but the break-even, the market-implied inflation, especially in the short end, has absolutely plummeted. So long-term, the market's sort of looking past the current pressure that was brought on by the rise in energy prices and the conflict, and really looking at inflation, being around that 2% level.
Stephen Laipply, global head of iShares, fixed income ETFs over at BlackRock, kicking us off to the close. We're talking about a month, a quarter, quite frankly, where we only saw modest gains in the Treasury space, maybe a little bit more aggressive gains when you factor in corporate debt. But this was really about equities and really, quite frankly, about tech stocks.
Big time.
Yeah.
I mean, you think about the quarter that was for the S&P 500, higher by about 18.5% on a total return basis. I believe the best quarter since 2020. I know you know for sure. The volatility, I mean, you wouldn't necessarily know it by looking at a chart of 3 months, but there was a lot that happened in those 3 months, from geopolitical headlines to some pretty blockbuster earnings, and the equity market just took it in stride.
Yeah, I was looking at some of the swings on just over the last month, because it's hard to even go much further back than June. I mean, we're talking about, so many months, so many days, sessions where we had, particularly on the NASDAQ 100, like peak to trough, like moving like 2% or more.
Oh, yeah.
So, I mean, and it was just like, after I got to like, May 30th, I just gave up counting them.
The point was made.
Yeah, the point was made. It's been volatile, but relatively lucrative as well. And of course, a lot of big questions about what the second half holds. Joining us here in Studio 2 to count us down to the closing bells here on the final trading day of the quarter is Tiffany McGhee, CEO and CIO of Pivotal Advisors. Tiffany, great to see you here.
Good to see you. Thanks for having me.
I'm going through all the data. And I mean, look, we know at the top of the leadership board, when we talk about individual stocks, it's a lot of the AI names, your SanDisk and Intels, Dells, if you will. But then I was looking at sort of what really contributed to the rally that we saw, particularly in the final 2 to 3 months of this first half. And I was actually surprised at the amount of dispersion out there. You had a lot of non-tech names, or at least non-AI names, that actually kind of held their own here. Is that sort of a sign of something to come up ahead?
Yeah, absolutely. You guys were just talking about tech. I mean, when everybody thinks tech, they think Mag 7, but we are really seeing that leadership is broadening. So, and not just away from these Mag 7 companies, from a handful of companies, but really in all directions, size, style, region. So we can look at the fact that emerging markets are up almost 23% year to date. One of the highest performing sub-asset classes, small caps, up 22% year to date. And then what I really love, or I really think is kind of cool, is value is up over 16% year to date versus growth, which through last week is not even doing 1% year to date, right? So we're talking about all these tech names and all this AI, and growth is really really underperforming value, and even from like a sector perspective, last week we saw healthcare creep up just in that week about just around 8%. And so again, year to date still down a little bit, not as much as of course some of the other sectors, but we're seeing sector leadership broaden. So but again, when I think about because we manage portfolios for foundations and endowments, we manage the whole portfolio, right? We've got to do so from a strategic asset allocation perspective. U.S. global market cap is over 60%. So there is a lot of concentration in portfolios right now.
Yeah. Well, when you say that, I mean, geographically, is there a strong case to be made for greater diversification outside of U.S. assets?
Absolutely.
Yeah.
I don't think we can talk about AI without talking about emerging markets. But I think that investors should really be thoughtful about how they're even like rebalancing, right? So if they have an S&P 500 fund, right? If they're going to do indexing, your traditional kind of 60-40, where a portion of that 60 is international, being thoughtful and looking at, looking at the regions in which that 10 or 20% is coming from is just really, really important. So making sure that you are really diversified by region.
Let's talk a little bit about the 40%. Let's talk about fixed income because, we've been talking on this show how it feels like there's just this total reluctance to go out the curve. It seems like the front end of the yield curve, shorter duration assets is where all the demand is. And I wonder, how you're sizing up the different parts of the bond market right now as we do navigate through all these different cross currents. Mm-hmm.
So again, everything that we do starts from a strategic asset allocation. And once we kind of set that, we'd like to have a cord and satellite approach, not just for the entire portfolio, but also within those different asset classes. So one area that I really find is kind of fun to, and I hesitate to use this term, but to kind of get jazzy with or like trick out is fixed income, right? So of course you have your core fixed income position linked to the Barclays Act. Okay, great, kind of boring. But then we like to kind of pepper that with definitely some high yield, right? Also some private credit, opportunistic credit. Again, our clients are institutions, so we can go there. Not every retail investor can go there, but one of the areas that really buoyed portfolios for us was opportunistic credit in that first quarter. Remember, so January, February, things were all going great. And then in March, we woke up and the world just changed, right? And so when I look at the areas that really kept our clients afloat in that craziness was private credit, opportunistic credit, real assets, and something we like to call defensive equities, which are kind of like a liquid hedge strategy.
Well, I love the idea of jazzing up, tricking out fixed income. Let's talk a little bit more about private credit because you think about the past few months in private credit, there's definitely some human psychology class you could teach on sort of redemption requests and how they build on each other. But how has this period of time sort of opened up the opportunity set for you?
Yeah, I mean, listen, when we think about private credit, of course, we're picking managers. And so I think a lot can be said for the due diligence process and how we select managers. We're not going necessarily to the biggest private credit firms. And then I think it's also important to note that, most of our clients, in addition to making money, they want to do so in a way that they feel really good about. And so there are a lot of, we make sure that our clients' portfolios are aligned with their mission, vision, and values, and some of that is diverse managers, some of that is like ESG type stuff. So those are the areas that we're looking in. We're casting a wide net, but those are the areas that actually have done really well for us.
I am curious just about where commodities sort of fall into this. I mean, overall, not great returns. I mean, it's good, I guess, that oil is down 20% over the last month. But when we start to talk some of the slump that we've seen in industrial metals, precious metals, et cetera, what is that telling you?
Yeah, so first of all, I can't talk about commodities unless I talk about kind of AI, right? Everybody's always talking about the AI trade. First, our perspective is that we are, again, with that kind of core and satellite, we are diversifying our AI trade. It's not just NVIDIA, Alphabet, Microsoft. We're thinking about the best way to do that in a diversified way for the long term. So we want to own the creators, like those companies that establish kind of like the foundation. We want to own the builders, which really help create the infrastructure, and we want to own the adopters. And so that's kind of where like copper fits in, right? So things like copper, these are the metals that we need to kind of power AI.
All right, Tiffany, great to have you. I have to leave it there. Tiffany McGhee over at Pivotal Advisors, counting you down to the close.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar, Tim Stenovic, they join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube here on the final trading day of the month and of the quarter. Carol Massar, you're rubbing your hands.
Because it's cold in here.
Oh, okay. I thought you were rubbing your hands because of the hot gains that we're seeing in this market.
Yeah, talk about those hot gains. I mean, you've got the best quarter for the S&P 500 since 2020, maybe even a little bit further back. best quarter ever for chip stocks. We just talked with our Eric Weiner. The way the semiconductor rally has moved this year, we are on track to have the best year ever in semiconductors if these gains continue and if these gains hold.
If the gains hold.
I know, big if.
Yeah, we'll see what actually happens, for the rest of the year. Let's put some numbers, though, to what exactly this quarter looks like. Well, looking pretty good.
I know. I was going to be optimistic at this point.
Well, you never know.
Let's just go there. Let's
15% higher for the S&P 500. The NASDAQ Composite up more than 21%. We'll just round that up to 21.5%. And the Dow, Katie's favorite, up this quarter, 13%.
I hear what you're
Transport's,
saying.
Katie, up 17.
I love transports, love those old economy stocks and price-weighted indexes. I will say that July historically has gotten off to a pretty strong start for the S&P 500, but think about other seasonal patterns, sell in May, that obviously didn't happen. So we'll see if any of those, old records or old patterns sort of hold here.
Well, it's been a little bit of a mixed month of June, but for the quarter, the gains are undeniable. We get the closing bells here on this June 30th, 2026, with the Dow Jones Industrial Average adding about 120 points here on the day, up only about 0.2% on the day, but that's going to be good enough for a gain for the quarter of about 13%. The S&P adding about 58 points or 0.8% on the day, 15% higher over the last 3 months. The NASDAQ 100 and the NASDAQ Composite each up about 1.5% or more than 20% for the quarter, and the Russell 2000 getting in on the action, a gain on the day of about 0.5%, up about 3.6% on the month and about 21% for the quarter.
Yeah, quite a move, right, in all of those indices. Back to the S&P 500, just for the day, I'm going to take a look. Kind of an even split, 211 to the upside, Katie, 291 to the downside.
Yeah, you see that on the sector level as well as measured by the Circle. Information technology, that is your bright green slice, higher by about 2.6% as a sector. We know that the chips had a good day. Industrials, materials also higher on the day, helping to lead gains. In terms of what didn't perform on this final trading day of the quarter, real estate down by 2.2% as a sector. You also saw drops of about 1.5% when it comes to consumer staples and utilities, Carol.
All right, let's go to some of the individual gainers. Got to talk about stuff we've already mentioned, but let's go there anyway. Philadelphia Semiconductor Index adding on another 4% for the first half of 2026. So chip stocks, as we said, looks like their best quarter ever. So quite a start to the year. We know the story, the AI demand for all things semiconductors. We should point out, though, it does feel like investors have gotten a little bit more skeptical, and we have seen some moves or some volatility in the sector. Eric Weiner of our Bloomberg team here just on air with us, and he said that the stocks is on its way to its best year ever. So we've seen quite a move. I just want to mention a couple of them. Chip tool stocks also rallying. So KLA 10 Core Semi Manufacturing was a top name in the S&P and NASDAQ 100. That went up more than 8%. ASML up about 5.6%. These companies rallying as increased investments from leading chip makers in South Korea bolstered investors' optimism. Latest strength in the sector coming after Samsung Electronics and SK Hynix announced plans to build 2 chip-making plants apiece in South Korea for a total of about $500 billion U.S. You also had Susquehanna adjusting the firm's price target on KLA to $275 from $1,700 and keeps a neutral rating on the shares. Firm updated its model following some channel checks. So well, you know.
Yeah, I also throw in there Ambarella, which had a fantastic day today, up 28%. That's the best day that they've had on record, and that was largely because of that rotation trade here. Rosenblatt actually naming its top pick, saying people are starting to rotate to some of these physical AI names, and I guess Ambarella, in the analyst perspective, fits squarely into that category.
Yeah, there's some movement, right? Yeah. Certainly around. Hey, just quickly, I want to mention solar stocks, Enphase, Solar Edge. We saw solar technology stocks.
Yeah, they should do well. It's going to be like 100 degrees this week. Is that how it works when it's hotter?
No, that's not how it works. Enphase was up 1.9%. Solar Edge up about 5.5%. This is on reports that the FCC is drafting a ban on imports of foreign inverters. And while Chinese manufacturers have limited U.S. residential market share, they do have a larger utility and storage share. That was coming out from an analyst. So we did see those names move. And then I just want to mention something that's kind of near and dear to us. We just did a remote in Vegas with the team over at Everpure. Well, this name, ticker is P if you're not familiar, stock up about 9%, jumping as Reuters says Java Partners built a new position in the company. If you're not familiar with Everpure, it used to be Pure Storage. They're a data management enterprise storage system company, and so that one was on the move kind of late in the day. Yeah. And if you missed our interviews, we talked to the CEO, we talked to the CFO.
Yeah. Wow.
They talked a lot about ROI when it comes to AI. That is certainly a
Hey, Tim, what do you got?
I got some stocks that are in the red. It might feel like deja vu all over again from yesterday because telecom companies fell for another day today, down 5%. And for the same reason, I'm going with AT&T instead of Verizon today, down more than 5% after it fell 6.3% yesterday. This after the news that SpaceX and Charter Communications are having executive-level talks about partnering on a consumer mobile phone offering that could directly challenge wireless providers, this according to 3 people familiar with the matter. But again, this is the second day in a row these stocks are falling as a result of those talks. It's about the concern that it has to the core business for the big 3 players, of course, when it comes to mobile phones. Also, let's talk a little bit about telecom, or rather communication services and those call center services. So if you're, on the phone with a call center and you're not necessarily talking to a person, you're talking to an AI, that's a concern for Concentrix, down today by 11.2%. These are companies that are typically handling actual human being requests and requests going to humans, but there's concern now that that's going to be replaced with AI. Teleperformance is another company that fell today. This after Concentrix cut its revenue outlook. It warned that some of its customers are cutting back on spending. Concentrix late yesterday also lowered the midpoint of its fiscal 2026 revenue outlook range by about $130 million. Executives flagged several scenarios where clients ended up cutting down on call center spending. It's funny, Carol mentioned Eric Weiner coming on and talking to us about the stocks. He also told us that he was buying a new iPhone as a result of, getting ahead of the memory chip, the memory, expenses growing. And he had an issue with his phone and he spent days with the AIs at a certain telecom company. And when he was finally connected to an actual human being, they figured out his problem in like 15 minutes. Wow. So I don't know. Do with that what you will. Any coconut water fans here?
Yeah, sure. Why not?
Okay. Vita Coco shares down by 8.8% today.
What?
4th straight session of declines. The stock down close to 20% over the last 4 days. Largest quad period drop going back to March of 2022. Still shares up more than 20% so far this year. Vita Coco down 8.8% today.
You don't have a reason for that, Tim? Or just...
They're just down.
Okay.
There was some talk about some index stuff, but we're not going to go there.
Okay.
Coconut water is
Don't go
Yankee.
there.
It's probably a good reason.
All right, if you care about yields, they're actually significantly higher on the day. Looking at about 5 basis points on your 2-year yield. The longer end of the curve, you're looking at about 7 to 8 basis points. Remember, this has kind of been oscillating back and forth for quite some time as everyone tries to divine what the next move is by the Fed.
All right, maybe this will make you happy, Romain. Nestle to change its Kit Kat recipe across Europe. They're going to make it crispier. They're also going to add a little bit of hazelnut tone to attract new customers.
Wait, I'm sorry. Crispier? How can they be crispier?
I don't know.
They're
Apparently
pretty
they can be.
crisp.
Apparently they can.
Break me off a piece.
Yeah.
September 2027, they'll add a 3rd level. That's how they're making it crispier.
A 3rd level?
Yeah, so when you bite into a Kit Kat, you see the different levels.
Yes.
They're adding a 3rd level.
A 3rd level?
Yeah, it'll give it a more complex level of taste without
you're
reducing
saying
the cocoa
Nestle is
share.
going to become like Gillette, where they just keep adding like blades.
Well, what happens if they add a 4th level?
Who knows?
But not in the
It'll
UK.
be unbiteable.
They're not doing this in the UK. Apparently they get, they like the preferred taste described as burned caramel.
I do like
UK?
the regional
that's pretty on
differences when
brand
it comes
for the UK,
to.
Yeah.
I like the regional differences when it
I
comes
had
to this
breakfast in
stuff.
the UK about 10 years ago. I think I'm still digesting it.
A lot of roasts.
Yeah.
A lot of roasts over there. All right, guys, that is a wrap. Our
I love
cross-platform
you.
radio.
Happy 250th anniversary, UK.
Radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Katie and Romain continuing on the close on Bloomberg TV. Tim and I back here on Bloomberg Business Week Daily, right here on Bloomberg Radio. Folks, we will see you again, same time, same place tomorrow.
Believe it or not, earnings season actually isn't over. We're awaiting earnings out of Nike imminently, so stick around. We're going to find out exactly what happened in the most recent quarter and, more importantly, how that company guides investors forward. That conversation coming up after the break, right here on The Close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A volatile month of June comes to an end, but a lot of gains for most of the major indices on the day. Not necessarily on the month, that the S&P did actually post a monthly loss, but still up on a quarterly basis. An 0.8% gain on the day. The Philadelphia Semiconductor Index, the star of the show all year long, not disappointing, up about 4% on the day. We continue, though, to see continued weakness in the Japanese yen, which, of course, yesterday hit the lowest level since 1986. That weakening continue today. And Bitcoin down 2.5% on the day. In fact, down about 20% this month.
Yeah, perhaps another quarter to forget for Bitcoin. Let's take a quick walk through the equity market, highlight some of the big individual movers. Telecom companies, as we were discussing with our radio friends, having another bad day, as evidenced by AT&T, down about 5%. Different story, though, when you take a look at the chip makers. Intel, one of your big gainers on the day, higher by about 6%. One of your biggest gainers on a points basis for the S&P 500 was NVIDIA, shares higher by about 2.6% on this final trading day of the month. But let's get to our top story this hour, and that is a fresh read on the consumer. It's just moments away with Nike set to report results. Now, these earnings come as CEO Elliott Hill continues his turnaround efforts, naming David Denton as the company's new CFO. Investors really looking for signs that the comeback is gaining traction, seeking details about those one-time tariff refunds, as well as demands tied to the FIFA World Cup, Romaine, which is underway right now.
Absolutely here, and we talk about the numbers as we await them for the fiscal fourth quarter that ended at the end of May. Investors expecting revenue of about $10.8 billion and more on the bottom line, adjusted EPS of about 12 cents. Zachary Warren joins us right now, equity analyst over at CFRA, who has a buy rating on a Nike. What are your expectations, Zach, heading into this print?
Yeah, we have a little bit higher expectations moving into this quarter, and then the year ahead. Nike typically outperforms in FIFA World Cup years, which would be from June on, so this next fiscal year. Typically they see revenues up 8% in World Cup years compared to 5 to 6% in non-World Cup years. So we've got a little bit higher expectations, and I think it's time for this turnaround story to start taking actually seeing some numbers and results from it.
And I am curious to get your thoughts on potential tariff refunds, because we heard from the company last week saying that its results will include an unexpected benefit here. I mean, are you modeling that in at all, or is this really more about the longer term turnaround story?
Yeah, we're not. We don't think that really matters to investors now moving forward. Investing, obviously, a lot of investors just look to the next 12 months, next 2-3 years. And we think the turnaround story is the much bigger story here. They've seen early success, right, with the Nike Mine product selling out across geographies, in just a couple of weeks. They've got running doing well. Running was up over 20% last quarter. I think that momentum should continue. And I think, analysts are under predicting their earnings power. We think Nike can do over $2 in earnings per share pretty easily in just a decent year. We think 3 is within reach in the next 2 to 3 years. So, we're really looking for a rebound here.
One of the big question marks, particularly going forward, is China and whether they can sort of get their mojo back there. Are you expecting to hear anything with regards to the progress that they're making, if at all?
Yeah, you've seen some early signs of a turnaround there. But, I think that's where they've got to grow, right? Asia and Asia Pacific is a big region for them. Nike has saturated the U.S. and they have been for quite a few years. They did see a little bit of an uptick during COVID, but that was mainly pricing and not volume. So the U.S. and North America is pretty saturated. Now they should see a little bit of uptick this year, hosting the World Cup and the U.S. gear that they sell. But we really think that it's the opportunities in Asia.
Hey, hold that thought. In conversation with Zach Warren over at CFRA, Nike earnings crossing the wire right now. Revenue in the most recent quarter, the fiscal fourth quarter, $10.97 billion, down about 1.1% year over year. We should also point out that revenue number does appear to be relatively just slightly above estimates of about $10.84 billion. EPS, 72 cents a share versus 14 cents year over year. I'll have to get you the comparison with analysts, but we did see a widening of margins to 49.6%. 39.2%, up from about 40%. Inventory did actually tick up just slightly higher, only by about 0.2%, but at about $7.5 billion. And Katie, we were just talking about the China revenue, Greater China EBIT, I should point out, not revenue, actually down 20% year over year.
Yeah, and then when it comes to Greater China revenue, $1.3 billion, that is down about 12% year over year. But you can see shares trying to decide what to do. Initially rising about 4%, now still green here, but bouncing around. And you have to wonder, whether the bar for Nike, the expectations for Nike were so low that whether it'd be easier for them to clear this hurdle. But going through these numbers here, it's going to be interesting to see whether or not these early after-hours gains hold.
Yeah, I just want to get a couple other numbers, too. I mean, the North American side, which, of course, has become the dominant part of the business, primarily because of the slowdown we've seen in Asia-Pacific, that was up about 2.7%, and that was really the primary growth area. Asia-Pacific and Latin America revenue did rise by about 1.3%, but China specifically was still down 12%. EMEA, that's in Europe and the Middle East, that was down basically about 1 percentage point there. We should also point out, too, and I think this is kind of interesting, too. They talk about the digital sales, and we'll have to dive a little bit into that. Nike brand digital sales down about 12%, though that's actually an improvement over the previous year when it had dropped about 26%.
Yeah, absolutely. Yeah. And on the China bit, I mean, this is what the company has sort of set up the market for, that you were going to see this strength, especially when it comes to North America, but offset by what we were seeing in China here. So, perhaps traders well prepared for that. Again, when it comes overall to revenue, that coming in a little bit lower year over year, but maybe slightly ahead of those estimates.
Zach Warren's still with us, so over at CFRA. And Zach, I know you've only had a couple seconds to digest these numbers. It looks like they're relatively in line with what the street was looking for. Anything jump out to you?
Yeah, it looks like gross margin, if you strip out the tariffs, we're pretty much flat year over year. Earnings, a pretty big beat. I mean, 20 cents. Compared to 12 to 14, I think is what analysts were expecting, and then a little bit of a revenue beat. Yeah, I mean, I think this is where you're moving forward. You're going to really want some guidance during the call. You're going to want to hear what they expect this year in terms of growth, right? You don't want another year where they're not going to grow revenue or earnings. I think that would be where you would see some downside to shares. But in our opinion, we think the risk has been priced in here. We think the next 2 or 3 years, analysts' expectations are really, really low, and valuation seems pretty fair.
And I'd love to hear your thoughts, too, on sort of the dynamic that we're seeing here between inventory and gross margin. We know that, when it comes to working down that inventory, perhaps having to discount to do that, there was some concern about margin pressure here. Their gross margin coming in at 49.2%. How are you thinking through that number?
Yeah, so inventory is tricky, especially with the tariffs and the uncertainty around tariffs. So, that we probably need to hear a little bit more from them in the call on how they feel about where their inventory is. We think they've got it almost to a place where they can kind of move forward and start to get some new products in. They've talked a lot about their new product offering and their innovation, and it'll be interesting to hear, moving forward in the call what they think and see.
Absolutely. Nike shares higher by about 1.5% in the aftermath of those figures. Zach, really appreciate it. That is Zachary Warren. He is equity analyst over at CFRA. And I do want to bring in our own Poonam Goyal. She is senior retail analyst over at Bloomberg Intelligence. She joins us now. Poonam, so similar to Zachary, you've only had a couple of minutes to look through some of these figures here. What is your first blush reaction?
I think it was a good print overall. Revenues came in better than expected, which is great. But I think what was a really interesting part here is the China numbers. I know they're still down 12%, but that's much better than the high teens decline that was expected. So some momentum in China, a long way to go, but we're moving in the right direction. The other thing that I want to point out is the gross margin, which you also talked about earlier. The increase that we see here is still not indicative of a gross margin trajectory that's pointing upward, because they do have a lot of discounting to still do. It's all tariffs, and that's all one time. So I don't expect this momentum to continue post the tariff refunds.
So give me a sense here. I know that we have to wait for the conference call to get a little bit more guidance, and I know there's a big investor day planned for later in the fall. But is there a growth story here that you think that the management can start to articulate to investors?
Absolutely. I think, look, they've already turned the page in North America. North America is positive now. It is improving. The next page to turn is in China. And it's not going to turn in the next quarter or two, but we would like management to outline a plan at their investor day in the fall to show the trajectory in China. Is it a 2028 fiscal growth story, or is it sometime in the next 6 to 12 months? And that direction will help investors gain or regain confidence, I should say, in the turnaround story.
Yeah, and give us a lay of the land here when it comes to this competitive landscape. You know, there's a lot of focus on Nike's turnaround story, of course, engineered by Elliott Hill, who's approaching 2 years in the job. But how does that fit into the broader context of what Nike is dealing with when it comes to some of its peers?
Yeah, look, competition is increasing. There are definitely more players in the market, and no one is willing to leave their share behind for Nike to easily pick it up. So innovation is going to be key here. Nike needs to continue to innovate, but even at a faster clip to keep up or beat competition, because the mind share is now split between the newer emerging brands like On and others versus it just being a Nike story 5 or 10 years ago. So there is more competition. There's more competition in apparel and in footwear. And Nike, we think, is making inroads into fighting that competition and really regaining its momentum, but a lot more work could still be done.
All right, Poonam Goyal, senior analyst over at Bloomberg Intelligence. We keep the conversation going and bring in Drake MacFarlane, research analyst at global data analytics firm Science. And Drake, I mean, your data kind of looks a lot closer at the demand picture from where exactly the consumer sits. When you look at that data, is it telling you that Nike is gaining momentum?
It depends on how you look at it. Certainly within the apparel segment, we do see Nike benefiting, certainly within the World Cup time period. That being said, footwear is still the area where Nike's still relatively challenged in our view. Just to kind of give you a sense of what I mean, over the past several weeks, we've seen substantial momentum for Nike as well as Adidas and Puma in the wake of the past 3 weeks of the World Cup kind of time period. Now, even though Nike's done well during that time period, we've actually seen Adidas well outpace them within the soccer jerseys segment. And so while Nike may be larger for overall apparel, at least during the time period right now within soccer jerseys themselves, Adidas actually seems to be outpacing them. So I would say kind of a mixed bag from that perspective.
Well, that's what I'm curious about, because, I mean, Elliott Hill has publicly put a lot of stock in these sort of big sporting events, whether it's the Olympics, the World Cup, et cetera. Obviously, the World Cup, the official sponsor is Adidas, not Nike. I know Nike outfits some of the teams, so that certainly would give Adidas a bit of a leg up here. But do you think that there is the ability for these events to actually translate into a meaningful uptick in sales, and more importantly, sales that are sticky or long-lasting, that go beyond the event itself?
You know, I'm somewhat skeptical of that. I think at least for an immediate term perspective, the apparel bump will definitely be helpful for Nike in my view. We certainly see it from soccer jerseys, but just more broadly. But if your view is that Nike needs to, say, reassert itself within its sports credentials, right, to fix the footwear segment over time, that's actually a longer term dynamic. And one thing to keep in mind is the competitive dynamic. It's not just Adidas as the primary competitor, say, 10 years ago. Now we also have players like Hoka and On, and even smaller ones like Salomon, which within the footwear segment itself have increased quite substantially over the past several years. So I don't think it's a straightforward path ahead.
Yeah, well, talk to us about that a little bit more, because, you know, we're well acquainted with the likes of Adidas at this point, also when it comes to Hoka and On. But talk to us about Salomon, for example, and, you know, some of these other upstarts who are coming in and trying to take a little piece of the pie.
Yeah, I think to your point, everybody's well aware about On and Hoka, but one thing that we've been tracking pretty closely in our data is the increase in Salomon, for instance. Over the past roughly 9 months, we've seen substantial growth for Salomon within our data, particularly in the US. I mean, it was a brand that's been in France for a long time, but in the US, it's very much taken up. And when it comes down to product, that's what really matters. And we see for Salomon, their XT6 product franchise is very popular in our data. Now, of course, that's a trail running shoe, maybe not what you'd immediately think is the next hot, lifestyle shoe. But to me, it signals that the immediate use case of a shoe, whether it's running or trail running or working out or what have you, isn't necessarily germane to why the shoe might become popular. Just to use Adidas as an example, the Samba shoe that's been so popular over the past several years, that's originally an indoor soccer shoe from, I believe, the 70s. But I don't believe that many people are using it for the intended purpose.
And Drake, outside of just the brands themselves, I do want to talk about, shoe design and how that's evolving because, you mentioned that you think about the thick-soled and chunky style shoes. It's something that you've been looking at. For context here, I wear Hoka, so I like the, inflated shoe look here. But you are starting to see some of those more low-profile, minimal drop shoes come back. And I wonder, whether or not we're going to see that cycle because 10, 15 years ago, that was kind of the shoe that you wanted to own.
Yeah, and there's a couple early signs that we've been paying attention to in our data. Salomon's actually one of them that seems to be benefiting. They have something called the RX Mary Jean, I believe, very low profile version of one of their shoes. But I think Adidas is actually pretty well positioned here. Of course, they have a low profile version of the Samba. It's a Samba Mary Jane, but they've actually been working on low profile for a while. They literally call it low profile. It's the Taekwondo, Japan, and Tokyo, or a couple of those. But Adidas definitely is moving towards low profile. But Nike has as well. You may have seen about a month or two ago, they put out something called the Nike Moon shoe. It's kind of a retro look from literally one of the original Nike shoes, but it is also very low profile. And so, from that perspective, you can see kind of the early hints that the chunky shoe wave might not be here forever. I will say, at least within performance running, I'd be surprised if it went more low profile. But for lifestyle, I think definitely low profile is the leading edge here.
All right, Drake. Well, you heard it here first. That is Drake MacFarlane. He is research analyst over at M Science. It's worth pointing out that Nike shares have flipped to negative, now down about 1.6% after hours as we await for that earnings call to start. But coming up next, we have more on Nike and its ripple effects into the broader retail landscape with Wendy Liebmann. She is CEO and chief shopper for WSL Strategic Retail. She joins us next. This is The Close on Bloomberg. We're watching shares of Nike as investors digest those earnings results in the aftermarket session. Joining us live to talk about the potential impacts on the broader retail landscape is Wendy Liebmann. She is CEO and chief shopper over at WSL Strategic Retail. Wendy, great to have you with us. And, to start on Nike, you think about what they're trying to do here, the ship that they're trying to right, this turnaround that Elliott Hill has been put in charge of. Give us the broader context, though, of what a brand trying to basically do this needs to do to succeed when you think about the shopper in this environment.
Yeah, thanks, Katie. You're seeing this sort of legacy brand that has such amazing heritage, right, that many of us grew up with, and all the competition in the marketplace. So how do you take the trust built in the brand, and yet how do you make it timely, relevant, and accessible to people where they want to buy it? So this is a market that's had just so much competition of late. Your previous guests talked about that. And I think that's the big challenge, as well as the broader challenge of where am I doing my business in stores, online, globally. So there are a lot of moving dynamics here. And then what's worth it for the, for the shopper who's tight with spending and saying, where am I going to spend my money? Who do I trust? What's fun? What's innovative? And how do I feel fresh and new if I'm going to drop $100 on a pair of sneakers or more?
Right. Yeah, and you touched on something that I'm wondering about. You think about, again, this turnaround that Nike is trying to get some traction with. It's not just competition with other shoe brands necessarily. It's competition for dollars overall. The point could be made, Wendy, when you think about the cost of living going higher. Groceries are more expensive. Gas is more expensive. The list goes on.
Yeah, absolutely true. And on the one hand, I could have a 12-year-old, 13-year-old saying, hey, mom, hey, dad, I want those sneakers. Remember those drop days? And you're saying, I can't do it. I got to fill up the gas tank to get to work and get you to school. So there's one of those issues. Then as the other is, it's part of my fashion, it's part of my image, part of how I set myself up every day. Is it worth that? But the economic issues are really powerful. Even if you are a fabulous brand today, you have to prove your worth in the way it works, the way I can get it, how I feel about it every day, because now you're competing with everyday essentials and not just another pair of sneakers.
Wendy, I do want to get your thoughts, though, on the higher end segment of the retail space. And this is particularly in light of the news that Saks, the company formerly known as Saks Global, has now come out of bankruptcy. Its CEO has some pretty grand ambitions for sort of reasserting itself as a multi-brand luxury retailer. And I know we've talked about this before, but what is the role of that, particularly here in the U.S. and North America?
Yeah, you know this. We've talked about it. I'm sure you're tired of hearing me talk about it. There are a lot of people with a lot of money. That's good news. And those people are looking for those luxury experiences in their fashion. There are lots of places now, the individual brands that have their own stores, own e-commerce sites. So that ability to create a really high-end, worth the visit, efficient experience where I've got lots of what I would call laying on of hands, lots of service, lots of great experience events. That's still viable, particularly for that group with lots of money, that top of the K curve. But at the same time, they have a lot of places they can shop, a lot of things they can buy. And so that's the big challenge in this market at the moment.
Well, one reason why I brought that up, too, because I also feel like when we talk about Nike's evolution over the years, I mean, they had made a big push into direct-to-consumer, the idea that they didn't necessarily need the wholesale channel. They've walked that back in a pretty big way, and Elliott Hill now trying to establish the relationships. You kind of mentioned some of these luxury brands, and some of them have actually been vocal about their what they say is their need to have a wholesale channel for some of their items, despite the fact that they do have their own websites and channels. Do you think that there is enough of a symbiosis there that can exist where these brands can sell through their own websites and their own proprietary platforms, and at the same time still fulfill and keep happy that wholesale channel?
I do. I really do. I think we've seen that time and time again with the advent of e-commerce, that actually not just at the luxury level, at a lot of other price points, there are times and needs and occasions when people do want that hands-on experience. In the luxury space, it's the level of service, accessibility, broadness of brand. So maybe I can't find this brand, but I'm looking for a variety of brand, and I can see that in a luxury department store space. We see that around the world. It's just here we seem to be more and more challenged with that. So I think we see time and time again now that both having an e-commerce channel, your own stores, and the opportunity to sell in like-minded spaces and experiences is really part of the everyday journey these days.
All right, Wendy, really appreciate your time. That is Wendy Liebmann. She is CEO and Chief Shopper over at WSL Strategic Retail. Meanwhile, let's take a look at some of the big movers after hours beyond just Nike. Constellation Brands higher by about 2.6% here, better than expected first quarter. We're also taking a look at Papa John's as well. Shares down slightly here. The company announcing a CFO transition. This is The Close on Bloomberg.
All right, we're awaiting the start of Nike's conference call in just about 20 minutes. One person that actually won't be on that call is their new CFO. He actually doesn't start until August. His name is David Denton. He joins from Pfizer. He'll be replacing Matthew Friend. And our next guest actually says that, well, when you look at his background, Denton's background, it's actually not all that unusual that he would maybe take the helm at a company like Nike. Nina Trentman joins us right now, senior editor at Bloomberg News, who helps to author our CFO column. And I am curious about this. You know, when we got this announcement last week, the first thing everybody looked at Dave Denton's background and said, he's a Pfizer executive. So what does a pharmaceutical finance chief know about running a retail and apparel brand like Nike?
Probably not very much, at least from the start.
Does it matter?
That was my reaction. I think, interestingly enough, with companies as big as Nike and Pfizer, what I'm hearing increasingly is that it doesn't really matter if you know the industry really well. What matters is that you know a business of scale that has a certain market cap and that has a long and winding supply chain around the globe, which of course Dave Denton has. Interestingly enough, still, analysts pointed out that he doesn't have industry experience and that therefore he will have a longer ramp-up time as he gets his arms around the new role, of course at an interesting time for Nike, as you pointed out.
Let's talk about the timing a little bit, because, you know, you think about Elliott Hill, he's new-ish. He's been CEO since October 2024. So at this point, we're approaching, you know, his 2-year milestone with the company. So what do you make of the timing of this specific executive change to the I almost said ETF, to the CFO role?
Yeah, it's an interesting one because oftentimes when we see CEO changes, we oftentimes then have a CFO change 6, 8, 9, 12 months later. So in this case, it's interesting to see that Elliott Hill waited up until now. Of course, the stock slump that we've seen is probably one of the reasons for why he's now bringing somebody in who can potentially help with bringing back trust on Wall Street. And of course, we have also seen changes at the company, like Hill did elevate other people internally last year. So there has been change, but not at this key position, the Chief Financial Officer up until now.
All right, Nina, really appreciate your thoughts. That is Nina Trentman. She is senior editor at Bloomberg News. And for more of Nina's reporting, check out her CFO briefing newsletter by scanning the QR code on your screen.
What?
You can see it there. Yeah, very high tech here.
That's a great headshot, by the way.
Yeah, there you go. Great headshot, great QR code.
I don't
Take
have
out
a
your
QR
phone.
code either.
There you go. Well, let's keep this conversation going because our next guest says that Nike is in proof mode. The CEO transition is over and now it's time to execute. Jeff Christian, he is founder and CEO of executive search firm Christian & Timbers. He joins us now. Jeff, great to have you with us. And let's actually start there also on timing because as you say, again, the CEO transition is over. What do you make of the CFO transition now about a year and a half, a little bit more than that, into Elliott Hill's tenure?
Well, actually, Katie, I'm surprised it didn't happen sooner. Normally, we'll see a CFO transition occur within months of a new CEO joining. And I think it's good timing, even though I've said that they should have done it sooner. Doing it now works well. And when I look at Dave Denton's background, what really interests me most is the work that Pfizer's done in AI native transformation. If Nike's really going to make a difference and in their numbers and be able to report to the street, much better results, they're going to be doing it through the results that they get from really doing agentic automation, automating workflows, driving higher efficiencies. And I've seen that happen at Pfizer. Pfizer, Lydia, their head of digital transformation, is amazing. Supposedly, they've done close to $5 billion in efficiency improvement as a result of AI transformation.
Yeah, so it's interesting here to hear your focus on AI. You think about this specific appointment here. We were talking about the unusual background going from Pfizer to Nike. Do you think that there was necessarily enough focus on that AI piece?
I don't know if it's there, but when I looked at the placement, when I looked at the transition and Dave's background, that's what really interested me because the CFO is extremely closely aligned with the CTO and the Chief Digital and Transformation Officer in these AI native transformations. And much of that transformation has to occur in finance. We're seeing companies replacing entire FP&A organizations. GE Vernova has taken out significant cost out of their finance group. So has many other companies. United Healthcare has also made major impact, and so has Pfizer. So I would expect to see some of that occur at Nike.
I am curious when we start to talk about this idea of kind of the CEO transition being over, and I also am curious, does that then put more pressure on Elliott Hill? I mean, the idea that whatever grace period honeymoon there would have been where he could have pointed to, well, I haven't got all my people in place yet, that's not necessarily the fallback anymore. Now it is just about the execution?
Absolutely. It's all about execution. It's definitely in proof mode. And he's got to start showing some major impact soon, or else he gets under fire. And we start thinking about what's the succession plan going forward at Nike. And what normally happens is we'll see a CEO, if they're under pressure and things aren't working, they make changes at the executive level and they start to do it beyond the CFO. So if we don't see performance improving, we're going to see more executive change. And if we don't see performance improving today, boards are asking their CEOs, what are you doing with AI? Where are you starting to get real return on investment with AI? And when I take a look at Nike, they're really just at the beginning. They've cut about 1,400 tech jobs. That's a good sign. But what else are they going to do? What else are they going to be able to do to actually improve performance as a result of AI native transformation?
I am curious, Jeff, when we start to talk about sort of how much of a runway new CEOs get, this isn't necessarily just specific to Elliott Hill, but you've obviously helped to place quite a few over the years. How long do investors typically give before they want to see the actual results of whatever was promised, or at least whatever they've been demanding? Are we just talking, what, a couple years or 5 years? I mean, is there sort of a general time frame that we should be looking to?
It used to be probably 3 to 5 years a CEO was given, and then it collapsed to maybe 3. I think that investors are putting more pressure to see CEOs starting to do things now, and that means, in the world of AI, everything's happening at a much faster pace. 3 years of innovation is now happening in 1 quarter. So we're seeing a rate of change that we've never seen before. I would say that Elliott probably only has another year to turn the company around before they're going to start thinking about a new CEO.
Interesting. Certainly, it does feel like the timelines have been compressed here. And with that in mind, Jeff, so okay, maybe a year. With that in mind, do you think that there's more turnover to come when it comes to the rest of the C-suite? We're talking about the CFO, for example. Do you think Elliott Hill, has more to go when it comes to maybe refreshing some of those seats?
Absolutely. Well, I was looking at their leadership team, and they got rid of Alan John, who was only there about a year, who was ahead of all their AI transformation. And now it's under their chief operating officer. So my guess is that we're going to see more change. We're going to see more change on the commercial side, and we're going to see more change from an operations perspective. They still need a chief digital and transformation officer, or CAIO, somebody that's going to really drive the kind of numbers that they need to put up.
All right, Jeff, appreciate it. Obviously, a lifetime of experience there. Jeff Christian, founder and CEO over at Christian & Timbers, who's helped to lead executive searches for Apple and Hewlett-Packard, Google, and quite a few other major companies there, as we await that conference call from Nike at the start of the hour. Still ahead, though, we are going to turn from what's been going on with Nike and the world's largest sportswear company to one of the biggest stars in the world of basketball. NBA Hall of Famer Yao Ming. He joins the program next. This is The Close on Bloomberg. And some breaking news involving President Trump. We have learned that his financial disclosures, his annual financial disclosures, have now actually been released. They had been submitted earlier this week to the Office of Ethics, which has now posted them. Our Bloomberg reporters are combing through them, and we will bring you any information, material information out of that as soon as we get them. We'll do that here on The Close. And of course, we'll do that at the top of the hour with our team over at Balance of Power. So stay tuned for that as we continue to see exactly what's in those disclosures. We do want to go back, of course, to the top story of this hour, and that was those results that we got out of Nike. And we actually had a chance to catch up with a former Nike athlete, Yao Ming, of course, the NBA legend, Hall of Famer, and now playing the game of, well, a bit of an ambassador between the relations between Shanghai and New York. He's got a lot of businesses out there, and we had a chance to catch up with him. Here's what he had to say.
Basketball is the most popular sports in the world. I know this, FIFA's World Cup now is probably top is headline for all the newspaper today. But I have to say that basketball is shoulder to shoulder in China compared to football or soccer, what we call. And that influences so many of the young generation that they play on a basketball field every day after school. Sometimes they skip school for that. After me, there's many young fellows who joined the NBA. Last year we have a young player called Yang Hansen Young, who joined the Portland Trailblazers. I'm sure there's many young players like him that eager to reach their sky, hopefully here in the next few years. So basketball really connecting us together on the same field, and that's the magic of it.
Well, one of the places that the NBA is trying to expand is in Europe, specifically trying to build a league there. Are you in any talks? Do you have any interest in potentially being part of the ownership process?
That's a big news, obviously. Yeah. It's a very big news, and I have a few European friends. We're talking to each other once in a while to see how that's going. So, now, I wish all the success. I'm sure NBA have their rich experience to help this being a success, and I'm sure they will bring this sport to another level.
I am curious about the cultural impact. When we talk about the NBA's impact on China, and obviously the exporting of our brands, whether it's Nike and some of the other brands out there, Reebok, which you were a part of as well. We're also kind of, to a certain extent, seeing the reverse of that. We're seeing U.S. players now getting endorsement deals with Chinese firms. And I am curious as to what you see over there with regards to how younger consumers, the types of brands they're looking for, the types of products they're looking for.
It's very nice interaction. Stephen Curry just signed with the Liebmann brand, which is it's a huge impact. Everybody excited about it. And the Liebmann brand, his founder, Mr. Liebmann, is a national hero for us. When I was young, he won an Olympic title back to 1984 in Los Angeles. He's a national hero for us. And now, imagine, those. There's a hero from the older generation to the current generation that's really make a lot of. I'm sure that will be a very successful cooperation, and I'm really thinking that will be not only one, there will be more coming.
Well, I'd love to talk a little bit more about your investments, because one of them is the Asian University Basketball League. Nets owner Joe Tsai also is invested there. Talk to us a little bit about what your thought process was behind that investment and what you're hoping that, that can achieve.
I'm always excited about NCAA. The NCAA, besides NBA, NCAA is the most successful basketball brand in America. That for sure. And in China, that we have our college basketball league too. But also Asia, especially Asia is a big market, and there's many famous college basketball team that are out there. And I spoke to Joe that we agree that they need a platform that can put everybody together, and we're sure that in that area we somehow, hopefully in the future, after a couple of years, that we can create similar things like NCAA.
And that was Yao Ming, NBA Hall of Famer and chair of Yao Capital, and also easily the tallest person I have ever met in my entire life.
Yeah, it was interesting because we had Shaq on a while ago, who's a pretty big guy. Yeah. And looks like Yao bests him by,
6 inches?
Yeah,
I think,
no, not that
I think
much.
it's 6 inches.
Well, okay, well, he was a large man.
Yeah, both super tall.
Very nice, but it gets to this idea. I remember when he came to the league, this was a huge deal for China to have a player, not only just a player, but to have the #1 drafted player in the NBA. And of course, he made his mark. The whole idea was the NBA was trying to expand over there. China was trying to have some soft influence over here. And he was a big part of that.
Yeah, big time. Certainly a cultural phenomenon. Also really interesting, some of the work that he's doing now, trying to maybe bring some of that NCAA model to China and their university system as well.
Yeah, and he talked also about his foundation, his family foundation, which was originally set up as earthquake relief and now has expanded beyond that. Here, as we wrap up our coverage here on The Close, let's push ahead to what the markets are going to have their eyes on over the next 24 hours, Katie. And we get maybe a little bit of a read on the consumer and commodity prices in the morning with earnings out of General Mills.
Yeah, looking forward to that, a read on the consumer. We're also going to get pure economic data in the form of ADP employment as we continue the drumbeat to that Thursday jobs report. Also going to get an update on ISM manufacturing as well as S&P Global Manufacturing, PMI, and construction spending.
And we should point out that Central Conference in Portugal, this is basically a big conference of central bankers, is taking place. And we're going to hear from Christine Lagarde at the ECB, Andrew Bailey at the BOE. But of course, what everybody wants to hear from right now is Fed Chair Kevin Warsh, his first official public appearance overseas as Fed Chair. Yeah, going to be very interesting to hear his comments in isolation, but also to see how he plays with the other central bankers on stage. And tomorrow, also the deadline for the U.S., Mexico, and Canada to decide whether to extend the USMCA trade agreement for another 16 years. Big implications for the auto industry, among others. That does it for us here on The Close. Stick around. Balance of Power is up next. Some breaking news on those financial disclosures from President Trump.